Other types of accounts that you should get familiar with are cash and inventories. First, let's talk about cash. The fact is that cash is the most liquid asset of the business, and it's also an important factor that will help you determine the company's financial strength. If you look into a company's balance sheet and you see that the cash balance is too low, this may not be a good sign. When looking at a business which has a low cash balance, the first thing you should question is whether the business has enough cash for paying off its short-term debts, or whether it has enough cash for covering its monthly expenses. In most cases, having a very low cash balance will potentially lead the business to many financial problems. And of course, that won't be good for your investment. On the other hand, if the cash balance is too high, this may not be a good sign as well. Having a high cash balance is a negative sign indicating that the business may have some problems with its expansion strategy, or in other words, the managers don't utilize the business cash well. For example, when looking at a business which has a high cash balance, you should consider that with a high amount of cash on hand, maybe the managers should run some projects which will help the company expand and generate more profits. However, they don't utilize the cash and keep a high cash balance. So there may be a problem with the management. When reading the company's financial statements, you have to question a lot. As a value investor, in order to minimize the risk on your investment, you have to avoid investing in businesses that have potential issues. The more you're prudent with your investment decision, the higher chance you have of making a profit in the stock market. Okay, let's talk about the inventories account. If you look into a company's balance sheet and you see that the inventory figure is too high, this may not be a good sign. Holding a high volume of goods means that the business needs to have a large amount of space to store its inventories. And in fact, most businesses don't have enough space for carrying their products. So the solution is that they have to rent or build a warehouse to keep their inventories. And of course, that will cost them a lot. You know what? More inventories mean more costs, and more costs mean lower profits. Another thing that you should care about is that having a high balance of inventories may be a negative sign indicating that the business couldn't sell its products, so it had to keep the products in stores. This would mean that the business had some problems with its sales and marketing departments, or there was a problem with its products. And most importantly, the business had to pay unnecessary costs for holding the inventories. In some cases, several types of products may become obsolete or damaged when being stored, and eventually, that will lead the business to significant losses. So, you see the potential problem with the inventories, so you should think twice when investing in businesses which have a high volume of inventories.